Hey everybody, it's Matt Miller with ERA Real Estate, and today joining me is the famous Whitney Loggins at First Down Mortgage. And if some of you don't know, Whitney worked with Chad Houseman over at First Down, but I do believe that Whitney is more of the brains behind the operation over there. And she's joining me to ask a question that we've probably both gotten a lot of calls on recently, which would be, why are my tax bills going up? Why is my mortgage payment rising? And a lot of people don't understand kind of what happens, especially if they're a first-time buyer that may have bought a house, 12 months back or 16 months back, that the reassessment doesn't quite get put on there right at the time of sale. But we wanted to kind of go through that with somebody who's an expert on that. And Whitney, I will let you take that away and explain, when someone calls you, what are you explaining to them and why is their mortgage payment and tax payment going through the roof?
Yeah, absolutely. Thank you so much for having me today. We are getting a lot of calls about this as well. What we're finding is, now that we're in the beginning part of the year, mortgage companies are doing escrow analysis of people's mortgages because the property taxes in Florida are typically paid in November. So the property tax bills would have just been paid by the mortgage companies. Now they're doing all the accounting work to see if they overestimated or underestimated on the bill. And so what a lot of people are finding is that at the time they closed, the mortgage company estimated the taxes would be one thing, and when the bill actually came out, it's a lot higher. And there's a couple of reasons for that. One is, if the seller, if it was their primary residence, they likely already had homestead. So whenever you closed on your mortgage, the homestead was already applied, and you basically got credit for that whenever
you got free homesteaded property taxes for 8 months, 10 months, 12 months, somewhere in that ballpark. Gotcha.
Exactly. So if you're somebody who then purchased the home as a second home or as an investment property, or maybe you forgot to apply for homestead, once that homestead exemption falls off, you're now being taxed at a higher rate. So that's one reason why your taxes could go up. A second reason is there is a cap on how much the tax assessed value can go up each year. So if the seller's been in the home for quite a while, they've already been assessed, and it's gone up likely to 3.5% each year, which is a nominal amount.
Let's, for an example, 15 years, somebody bought a house in 2005, they've lived there forever, they bought it at $60,000. Well, look around, there's feasible options that that $60,000 house could be assessed at $150 because it was 3.5% over those 15 to 20 years. And all of a sudden now it's a $480,000 house. It's going to be a big difference when you bought it and when you get reassessed.
Yes, exactly. So once the next calendar year comes around and you're now the new owner of record, the county is going to reassess the property, and especially in this market, at a much higher value. So you're also then getting taxed at a higher rate. And what we tend to find is that people get the tax notices in the mail, usually summertime, showing the proposed tax amount, but maybe they don't read it or they don't understand it. And then the bill comes out October, November, gets paid, and then the mortgage company notifies them of a shortage, probably February, March of next year. And that's when everybody's surprised, is that their mortgage payment's going up, to not only make the lender whole for where they were short, but also plan for the next year's bill so they're not short again.
Yep. And they're making up an overage at that, or making up an underage at that point, trying to put more money in. And you're like, wait, why did it go up so much? Well, they're trying to build that buffer back up. In the escrow too. So, and just so people understand, when we say, hey, they reassess, understand, I get this question, I don't know why I get this question a lot, but hey, what are the taxes on this property? Well, the taxes very simply are a rate based on an area, which most of what we deal with is mostly Jacksonville, which is pretty much all one rate, unless you have Jacksonville Beach, Neptune Beach, or Atlantic. They have different rates as well. So St. Johns County will have their own rate, but it is strictly tied to the sale price of the property. So it's not like one building could have a cheaper rate than one next door to your neighbor. So it's based off the sale price of that. So I think that's pretty much it. I wanted to be short to the point so people understood that. I appreciate you coming on, number one. Anything else that we missed that maybe would be pertinent to that?
Yeah, I would just say make sure if you purchased last year, go ahead and start applying for homestead. If it's your homesteaded property, want to get that in by March 1st so that the tax bill at the end of the year reflects you as the owner of record and you're getting credit for that. As we go through the year, if you get that notice of proposed taxes, read it. It'll tell you what last year's was and what this year's could look like. If you see a large difference, call me, call your mortgage professional, do the math. If you know how to do the math, you can start pre-funding your escrow, anticipating a higher bill if you at least read the document and understand kind of what might change.
For sure. So, all right. Well, I appreciate you joining me. And other than that, like I said, if any of my clients have any questions, they can obviously reach out to you or myself, and we'll get them squared away, or at least get them prepared for what's soon to come. So other than that, Whitney, I appreciate you joining me, and we'll talk soon.